Okay, hello everyone and welcome to another article video. So we're going to finish them soon. Hopefully, I think I've got last three left. Okay, great. So this one is called Time is Money, Trading Smarter, Not Harder with Time and Price. Now, as you know, the markets are open 24/7. And by the way, if you're new to the channel, welcome. My name is Meydan. I'm a fintech professional and a finance professional. And my fintech calculates the swing days, the trading hours with a pricing model. And we can anticipate when the markets will turn to the hour and the days in advance. Okay, so without further ado, let's get started. So the important thing here is time is money and we want to trade smart. The markets are open a long time, and because they are open a long time, we don't want to be messing around. So let's do this. We don't want to be messing around, wasting too much of our day, too much of our time. We want to pick those special moments. We want to know exactly when the movement is going to, well, highly likely going to happen anyway, so we can kind of like trade at those hours which are going to be volatile, where there's going to be a push and a drive in the market, plus that drive should take us to a target. This is why we've got time and price together, because the price should give us an entry, the time and price should give us a stop loss. Yep, you heard me right. Time and price should give us a stop loss. Also, it should give us a target. So let's go. Right, now we're in the 21st century and the whole world is running on bots. And in fact, if you look at any any company right now, quant trading is top, and everybody's looking for a mathematician or a physics department graduate with a PhD to trade the markets. Why? Because they want them to do computer programming, mathematical stuff, so that they can actually trade the markets more efficiently and effectively. But bots will do just one thing, and they will react to a certain situation in the market, and that is not predictive of the market. That is basically a calculation based on what happens. So the bot will, according to volatility or according to moving averages, actually everybody uses moving averages, because even if you're using indicators for pricing, you're going to use some data that happened in the past to kind of project what you're going to do and where you're going to follow it to. So at the end of the day, everybody's using price, but nobody's using time. So here's the advantage for us. We are used to walking on two legs, God forbid unless you're disabled, right? So if you've got two legs, you're using your right and left. And in trading, we're basically focusing on price and a setup according to the price. And if there's volatility, we try to get in. And we usually, if you're a retail trader, you'll usually get in late. Okay, why? Because the market comes to a place, the big players get in. The big players will also only get in if the price is right for them, and retail traders don't really do that. They get in when they kind of like to confirm things with a U-turn, which is actually not a bad idea either. It's not a bad thing. You can also do that too. But with time and price trading, what we want to do is, in a market that's going all day, every day with crypto 24/7, what we want to do is trade smarter by knowing exactly the hours the market is going to make a move, and especially also the swing days. All right, so we want to make sure we've got the future swing days, the swing hours, and the price levels before we do any trading. So let's take an example from here. This is gold. Okay, so I'm just going to get rid of this. The reason I put this on is because the vertical lines are trading hours. As you can see, at these trading hours, we had moves happening at these trading hours. You see the market, trading hour, market down, making a low, pushing up, trading hour, pushing up, trading hour, pushing down, trading hour, pushing up, trading hour, pushing down. You see how these trade hours are working. What we want to do is actually match it to price and a swing day. Now, gold has a swing day this week, which is a Tuesday. So if I come here, this week is the 16th to the 20th of June, and I've posted all of this on the 21st of May, right? So on the 21st of May, we already knew all of the swing days and the swing hours, as you can see, for the month of June. So knowing all that is handy. So I've got gold Tuesday, right? And last week I had gold on Friday. So Thursday, Friday, we had swing days, market pushing up, Friday making a high, coming down into Tuesday. Now, because we are on a low on a Tuesday, I do want to get in. And yesterday I mentioned that there's a price gap here at 1360, so we'd love to close this and then push up. Now it didn't come and close it, but it was pretty close, and actually it was at a trading hour at this line here, this vertical line here, as you can see, right? So if you can see that, it's that one there, right? 5:30 of yesterday, and that's there. All right, so the market dips down and then bounces up. So today we're in a same kind of a dilemma, and obviously we need technical analysis, and you can see this is a sideways kind of downwards channel coming down, but we're looking to buy, okay, because Tuesday it made the low. Today's a Wednesday and we have not made a lower low. I don't mind the market coming, stop sweeping and pushing back up. That's okay to do so, but I don't want the market closing below a Tuesday, because if it closes below a Tuesday, then I understand that I might have made a mistake on my swing day. Okay, so I don't want to be in a trade where I might have made a mistake. So knowing the swing day in advance also allows me to make sure that, you know, I understand my risk, and if I do make a mistake on the direction because it closed lower than the swing day, then I don't want to be in that trade towards the upside. Okay, so we've got to think about it, and that kind of process really helps us to minimize risk and maximize profits, right? So we are in this zone here. Now what I'm going to do is I'm going to get rid of this so you can see things a little better, right? So this is Tuesday. All right, this zone is Tuesday, and today we're on a Wednesday, and already today you can see at trade hours market pushing down, at trade hours market pushing up, at trade hours market pushing down, and today is Wednesday, as you can see, and those are the hours. And I've also made two of these hours in bold. You can also make this hour in bold as well, but once the news comes out, as you can see, there's a pre-news setup, because today we've got news, haven't we? Yes, we have. And that's coming out at 3:30 and at 9 o'clock. As you can see, we've got FOMC statements happening and so on. Now, when these things come up, we're going to end up somewhere at a target by 10 o'clock, right? So these talks, the FOMC, Fed statement, interest rate decisions, all of this is going to take us to a place where the market should stop and stall by 10 o'clock, okay? And Asia session is going to be important for us, right? So I'm looking at my book here. I've got the big book, okay, where I got all my notes. In case you haven't seen it, it's the mother of all books, as you can see. It's a AA4, where I've kind of calculated the swing days and the hours, and I can check them out, and I can see which one is a better hour to trade, what's a good hour to trade, and so on. So today we don't have a swing day as well. So if we take a look, we come up here. As you can see, I've got no swing day. Today is a Wednesday. The only thing that can happen is on a NASDAQ, all right, or Bitcoin. So I do have swing days for Bitcoin and NASDAQ, but this is Wednesday or Thursday. Dow Jones has a Thursday. SP 500 also has a Thursday or a Friday. So I've got Thursday in common for for all three of them on the indices. So obviously that day, that Thursday, is going to be an interesting day for me. And if I know that in advance, then I can go to, let's go to SP 500 here, US 500. All right, so as you can see, I had a Friday, Monday, Tuesday. All right, that's your Monday and Tuesday from this week, and then I've got Thursday, Friday. So if we end up somewhere on the high end, we want to be selling off. So then I can do Thursday here. Okay, if we're up somewhere, we want to sell Thursday and Friday, right? And Thursday obviously is going to be a day where we got NASDAQ, SP 500 and Dow Jones all have that day. All right, as you can see, Thursday, and Thursday. Okay, and on Bitcoin we've got Wednesday. So if you take a look at Bitcoin, we've got Wednesday. So if we end up somewhere on the high end, okay, we'll look to sell on Wednesday, right? So that's our Wednesday. So we're going to see how that pans out, and we'll see. All right, let's get back. So what we want to do is to ensure that we predict. Instead of watching the screen all day and looking at the prices going up and down, what we want to do is we want to predict when we can trade properly. We want to know when the market turning points are going to happen in advance. So for that, we need time. So the swing days, swing hours, right? And then that's going to give us the cut down on screen time and noise, because we're not going to be standing there looking at the screen waiting for setups 24/7. Also, when news is coming out, you got to understand that we are completely independent of news. A lot of people wait for the news, right? But we don't trade that way. If I've got swing hours or trade hours, I like to call them, before the news, it's a setup. In fact, I had done that this week and posted it in the members area as the news was coming out. So it was, I think it was Wednesday. It should be Wednesday. Let's do this week. Why is it important? Because here is Wednesday. It was 3:30 on a Wednesday and on a Tuesday. Wednesday's today. And we had news coming out on Tuesday, 3:30. There you go. All right. And we had a setup before the news at 2:40. I trade gold, so that's me. And that setup is 240. 240 there. That's your 240, right? As you can see from there, the market went down. Okay, now my bias is to the upside, so I didn't sell gold. Okay, but that 240, you can see the market came down. Now the next trading hour after the news is 5:30 to 6:05. So you don't need to do anything. That's your 4 o'clock. 5:30 is there to 6 o'clock. So 5:30 to 6 o'clock, you can see the market going to the upside. Does a slight retracement and pushes up. This was also a trading hour. So if I know the hours in advance, 7:45, that's 7:50 there. And I've said it's a mild time. We could just hang around in these levels. So knowing that in advance is obviously a good thing because we're just hanging around. Okay, so knowing that in advance is good because then you're not in a big expectation. You can cover the trade, move stop loss forward and not muck around with it. Okay, so knowing that information beforehand is obviously important for us. Also here, this is the euro dollar. At the trading hour, market pushes down, New York opens up, and then we're back down. As you can see with the trading hours, market pushing down, trading hours pushing down. And this is a good example of a trading hour breakout, which we can also take a look at some other time. We have an impulse wave, market moving up a little bit and then selling off exactly at the trade hour, and that's already going to give you a good scalping move. So if you're a scalper, timing is obviously really important too. Same thing with SP 500. As you can see, this is SP 500. London pushed down, then buying on the trading hour, coming up into New York pre-trade session, then the trade session, pushing all the way down. Okay, so obviously going with our bias as well with the SP 500. As you can see, we're to the downside, so we want to sell on any movement that's retracing to the upside. So knowing that will cut down on your screen time. You can plan with higher conviction because time and price, they'll come together, they'll correlate, and it'll also eliminate emotional reaction based decisions. So you don't want to be just reacting to the market every time you see an up move, down move, you're saying, oh, the market's going up, oh, the market's going down, oh, what's happening? All that kind of jazz is out of the window because you know the times you should be looking at the market. Now, it's not obviously 100%, but it's highly correct. It's high probability trading. So when we're matching it to time and price together, when we're matching time to price and using them together, we are highly effective and our hit rate is quite higher than the other traders. In fact, higher than professional traders, because professional traders will get about 50% of the time right and wrong. Really, it's like a coin, toss of a coin. So what's important? Money management is important. Okay, but this way you have a strategy and your sanity in place. It's going to help you because you're going to forecast the market rather than reacting it to it. You're not going to trade every day. You're going to trade on good days, known as swing days. You're going to trade at good hours, called trade hours, and you're going to match it to a price. You're not just trading anywhere anyhow. You're using the methodology with time price correlation, and you're looking for a match. So you're not diving in. You don't have to trade every day, and this is the beautiful thing. You can use your day to do other things, right? For example, we've got nothing on today until 1:30 to 2:40. No, it's Wednesday. 2:40 to 3:45. We've got nothing on here until this time, and now it's 12:20. So I'm going to finish the video. I'm going to hit the home gym. I've got a gym right in my study room here, and take some time off, and then I'll come back to the screen because I do want to trade gold. I do want to bring it into a good price to take it up again. All right, so I'd like to wait for that to happen. And what are the kids doing? All right, here we go. I'm back again. Okay, Altan's got his summer holidays and they're all having a swim with their friends, right? So what do we want to do? We want gold to pull back into those hours, and if they're in those hours, I'm going to look for a buy opportunity, or I'm going to look for a U-turn, and when that happens, it should be like kind of pushing up in that direction. If it fails, breaks under, I'm not going to be in that trade. So the risk is very minimal, but I know the hours to look out for. And knowing these hours is a blessing because I don't have to muck around, think about, well, what's going to happen here and trade, according to what's happening at the time. I just want to trade at the right hours, at the right pricing. Okay. This allows me to trade with better risk returns. Okay, so also the same thing for Thursday, Friday. Knowing the hours in advance is your blessing. You've got targeted price zones, so it's not going to be just any time when there's a trading hour, right? So we're not just saying, oh, it's a trade hour, let's go. All right, that's not going to happen. Although, if you take a look at here, it's not a bad thing, trade hour, market down, trade hour, market up, trade hour, market down. So if you're scalping the markets, which I do not do, all right, because that's not for me at all. If you're scalping the markets, then you can also use the hours to, determine when the hour is turning, the market is turning according to the hour, and just jump in, take what you're going to take, and just get out. Okay, so once again, if that matches price, it's a much higher probability. So you got your targeted price zones, you're selective trading, you're better performing because you are selective in your trading. So you're not going to be diving into anything. You're going to wait for the price and the time correlation. And the beautiful thing is, you know what hours to look out for. A lot of people are sitting in front of the screen waiting and waiting and waiting for the price to get there. You don't have to. You can just look at the market when there's a trading hour, and that's it. And if that trading hour is at your price, then you got double the confidence that that thing is going to work out, and then you can just follow through. No gimmicks, no monkey business. It's just nice and selective. Multi-market efficiency. Now you can use this on anything. Also, knowing the swing days allows some people to trade options for a few days because they can jump in on a swing day and follow it to the next swing day, right? So for example, let's take a look at gold here, right? So if I know swing days, this is a Thursday, right? So if I'm going with Thursday into there, then I can trade it for a few days. I could trade it actually until if it's an closing on the date option, right? So if it's the last day of the option, if it's expiry day, you can also do that as well. You can just trade it to the upside. Or here you can see the market pushing up, going higher from the lows, going low from the high. As you can see, these are like pretty good days because it allows you to get in there. All right. And I also another good thing is, you know what's going to happen next week, right? So you got the swing days for next week. I've already done 3 weeks of July, so I'm just gonna do the last week of July, and I'm gonna post that on well, I'll probably post it on the weekend so that we can have the full month of July as well. So I already know what the swing days are going to be for next week. Person just needs to click on it and go in there, and they'll have the swing hours and the days. So you can also follow that through as well by trading options. Then you got the pricing model here. For example, 51.12, it's a price of 3,340, okay, which is down here. Now, this is a good price because it's a PST price, and despite the fact that it's below the swing day of Tuesday, if it gets there, I will buy it because it's a daily PST, and I will do so if it's the right time to do so, because you will definitely get a reaction here. It will come, market will buy if the time is right as well, and you'll get a good reaction. It'll allow you to take profit off the table, and if it sticks, it can push up even further higher. So this whole concept here is really good, and the market is snaking along, as you can see. All right, so that's also very good for us. What we want to do today or tomorrow is, we can also have a breakout trade. Once the market breaks above, you can also use the timing for breakouts as well. And sometimes you'll see that we do something called a goodbye kiss, which is also on like here. All right, you can do this. All right, so that's your impulse, that's your flag. By the way, when you're doing technical analysis, which I urge you to learn as well, what you can do is match the breakout to the hours as well, right? So if that's your impulse flag, you want to sell it off, it's at a trading hour. Okay, so that's 7:45 there, and on a Tuesday you can see you had 7:50. If I turn that into a 5-minute chart, let's see what happened at 7:50, and then we can have a better deduction as to what happened to the time. All right, so that is 7:45, and that's your 7:50, and the market just sliding down, as you can see, nice and easy, coming to targets. Okay, we're never working without targets. So getting this done at trading hours gives you much more confidence. And put that back into the 15-minute chart, and you won't be wasting a lot of time. You'll just be doing your trading. This timing will work for multi-markets. So I give the hours. When I give the hours, as you can see, this is not per asset, this is standard. Okay, so if you're going to trade whatever you're trading, if you trade Bitcoin as well, you're still going to look at the same hours. If I go into Bitcoin here, let's check it out. All right, let's go to the daily. These are the swing days. Now remember, with Bitcoin, I'm a seller from the highs. I don't want to be buying the highs. I want to sell it down, right? So my bias is to the downside. And we had what, Monday? Bitcoin Monday, Wednesday, right? So that's your Monday. You see how Monday from the lows goes up, and also Friday. Look, Friday, Saturday, Sunday. Friday was a swing day for Bitcoin. All right, Friday, then we've got Saturday, Sunday, market does not come any lower. All right, and then Monday, boom, goes up. Now with Monday, I've got 2 arrows here, as you can see, right? Why? Because we're on the low side, so we want to go up. But if it gets somewhere, watch the video I did for it. Sometimes you might not find my daily videos here. You can go to watch them on Vimeo. I normally put them up there afterwards. They just go live. I just can't be bothered to download and upload it to YouTube all the time. So that's your Monday, and as you can see on Tuesday, the market makes a high on Monday, and Tuesday just slap it down. Okay, and on Tuesday, that's how it is. Now, if we match the hours for Tuesday, let's take a look at Tuesday. So if you're in the US session or the London or the Asia session, you have to look at these hours. If they match your technical analysis pricing, you're in. So I've got 650, 930. As you can see here, 650. That's your 650 there. Okay, it's a 15-minute chart. Let's do that. And then what? 930, 1015, 130. 930, 1015. All right, this is 1015 here. Okay, 930. Now 930, 1015, as you can see, it's nothing anywhere here. Why was this a good hour? Because that's an impulse, and if you're measuring it, okay, like we've learnt, that should bring you to a place where you can sell off. So if you've got an impulse wave, you can see that's 37.5, and if you're watching my videos, you know 37.5. Okay, that's the impulse, 37.5, and you've got a trading hour here, then that's boom down. All right, Then what are the other hours? Let's take a look. 132.40, 130. It's just breaking down on those hours. Look at that 130 breaking down. Coming into 240. 240 is on that bar. Market stalling sideways. 530 to 605. 530 is there. Market crashing down. 530 to 605. Selling off already. So this is your sell bit. Okay. And we've got 750. It's a mild time, so we could just hang around there. Okay. I've also made an additional note here. Look, check this out. Additional note, 4 to 415. All right, 4 to 415. Let's see when that is. 4 to 415. That's 4. That's 415 right under the weekly. So if you sold around here, you would have just needed to put your stop loss above the weekly pivot, because if the time is right, you're in. Okay, and then we had 730. Where are we? On 730. 730 is here, as you can see, and the market just hanging around there, close to that level there. Okay, so then you know how to cover your trade, take profit, and so on. So knowing these things in advance, using your technical analysis skills, matching it to time, and if you understand that the bias of the day is from the highs to sell off, you can do that on a trading hour. Okay, and obviously here you can see I've got a pricing model here, so I am expecting the market to push down, as you can see on the weekly. Okay, I'm expecting the market to push down. On the daily, as you can see, my indicator is pointing to the downside, so I do want to sell at trading hours if the market should come up into a decent place for us to sell, and looks like it's doing it. So if I take a look at what time that was today, let's see if I had a time in at around 8 o'clock. Today is Wednesday, 7:45, and I've made that bold here this morning. So 7:45 is on that bar there. All right, so 7:45, we're on a daily pivot, market slipping down. Okay, I can get rid of these now. If I want to measure a target, I need to have a target, right? All the time. Here's my targets. If I push down, that's one price target. On the daily, it's just all the way down here, so 92,819. So that should bring us into about this green box. Okay, and on the weekly, as you can see, there's a target going all the way into 49, which is 94. Again, from 89,532, 92,463, 94,840. You can see the price levels are precise levels. So all you have to do is just put a horizontal line onto those levels, and you got yourself this zone. All right, so the market should, if it falls, bring us down into this zone. So then on all the swing days from the high levels, we can push into this zone. And this is why knowing the swing days and the swing hours in advance is really helpful, because you can use all the technical analysis that you know, match it to a swing day, and then the swing hours, the ones I've given in the swing hour, the trading hours, you can match it to your technical analysis. Say, okay, this is time and price, let's get in. That way your risk is also very small too. All right, so what sets us apart? Well, first of all, we are predictive. We're not reactive. And this is really, really important to understand. We're not looking at the market and reacting to what's happening. I want to look at the market at a specific day, at a specific hour, and see if it matches what I want to do. And if it doesn't, I say, have a good day. I'm not interested. All right, so that's already, it's cutting out a lot of stress, because it's not setting up according to the time and price. So being preemptive allows you to plan better. You can risk manage better, you can plan your trades better, you can see if it matches your setups without all the pressures of time and the sudden movements in the market. Also, if you know there's a setup pre-news, then obviously that's going to be great, because you can set up accordingly. You can in fact straddle a trade with news if you got pre-trade hour setup opportunity in your technical analysis and time coming together. This is why when I look at the news, I'm not looking at the news to see what's going on. I'm looking to see if there is a setup before the news comes out. Is there a setup before or after the news comes out? And today there is, because I've got a setup at 10:30 today, right, in the evening, right, my time, UTC +3. So if I know that the Fed's going to talk, okay, at 9 o'clock and 9:30 there's a press conference, okay, and then I've got holiday on Thursday. So holiday on Thursday, well, that means the swing days on Thursday are not really going to matter, but we're still going to keep an eye out for them because Asia, I guess, will be open, right, and Europe will probably be open. Okay, so knowing these hours in advance, I can set up before, like I gave you with the gold example that I did on Tuesday. You can anticipate volatility. You don't have to muck around. You don't have to guess. You know, it's just simple. At what day, at what hour do I need to be in front of the computer? And time market turns with accuracy. We've got a high degree of accuracy, and that is really, really important because everybody else is punting it. And also, if you don't have time as a variable on your side, then, you know, looking at the markets is just, well, you know, according to what? How long can you stay there? How long can you be in front of the computer? Okay. So this is not just about pricing, but we want to use timing as well. So instead of chasing trends, chasing the price, and going after stuff, you can just plan in anticipation of what's going to happen ahead of time. So final thoughts: trade with purpose, not pressure, because the biggest problem for traders is the psychology of it. A lot of traders lose money not because their technical analysis is bad, or their money management is bad, but their psychology, the way they approach their mental status is pretty bad. And this is why a lot of traders fail in trading, because they can't handle losses. Okay, so because they can't handle losses, sorry about that, then, you know, they lose it. They do revenge trading, they enter trades again, on and on and on. So what we don't want to be doing that is we don't want to be going out of our mental state and doing all kinds of crazy trading or revenge trading or getting pissed off with the market either. You don't need to be upset. If you got time and price, and if it's wrong, that's it, you're not in there. And it's a minimum loss. And with losses, you can come to an understanding that you are going to lose trades, and I really often do as well. I have stop outs as well. And when I do, it's just how it is, just how the nature of the market is. But if I've got a 67, 72%, 67% hit rate, I'm really not fussed about it. I don't mind small losses. I really don't. But I do mind big losses. So knowing the swing days and the swing hours just allows me to do minimum risk trading. And then I can get in and get out. And if I've made a mistake, I made a mistake. On a few occasions, I get stopped out because when I'm entering a trade, you know, I don't want my stop losses above, you know, these places when the trading hour is here. If my bias is to the downside, and if I traded here, my stop loss should be just there, because time and price, if they're right, I don't want to be having a stop loss saying to myself, well, that's the high, I'm going to put it even higher because they could do a stop sweep. That is big risk. Okay, that's your risk return 1-to-1 if you're going to get out, and that's just not the right way, in my opinion, to trade. So knowing everything in advance, I'm just going to put this back into where it should be. Knowing the hours and the days with pricing in advance, it's just going to give you an edge. Money management on its own is not an edge. Psychology on its own is not an edge. You need a trading edge, something that gives you the edge with respect to the market, which you know that it's going to work highly likely in your favor. Then the money management and the trader mental state, the mental framework, the trader psychology comes in then. All right, and when you bring them together, you can be successful. Otherwise, you're going to be, you know, pulling your hair out. All right, have a good one, and I'll see you guys in the next video. I hope you like the videos, and all the best.